Cost of sales journals are particularly relevant in a retail environment where companies selling physical merchandise. The cost of sales journals record how much the merchandise costs the company. So in companies rendering a service, such as consulting companies or services companies, there might not be an explicit or easily identifiable cost of sales figure. Frequently, these companies will not have a cost of sales line item, but the expenses they incur to render the service will be classified under operational expenses of sorts. We are going to focus on a traditional retail company. Let's do a couple of examples. Amazon incurred $8 billion worth of cost of goods sold during the month of January in the current financial year. What would the journal entry processed be? There would be a debit cost of goods sold in the income statement, showing how much that merchandise which they'd sold had cost them, and then there would be a credit in the inventory on the balance sheet of $8 billion, showing that that inventory has been sold and reducing the value of inventory in the balance sheet. How would this be reflected in the T accounts? If you had to see the journal reflected in the T accounts in GL, you would see a debit of $8 billion in the cost of goods sold T account and a credit of $8 billion in the inventory T account. Let's do another example. Similar but different. During the month of February, Amazon incurred $12 billion worth of cost of goods sold. What would the journal be? Again, a debit in the income statement of cost of goods sold of $12 billion, but then the corresponding credit would be to inventory of $12 billion. If that had to be reflected in the T account, you'd see the T account having a debit of $12 billion in the cost of goods sold T account and a credit of $12 billion in the inventory T account.